Hi, I'm Michelle Edwards, CPA, owner of Trailhead Accounting Solutions. Thank you so much for joining us. Today I want to walk you through the top 3 reasons why your business might be strapped for cash. Now these aren't the only reasons, but they're the top 3 that I see with my clients, the most popular ones. Number 1, you want to look at your profit and loss statement, also known as your income statement. You can find this in QuickBooks if you go over to Reports, drill down to Financial Reports. Sometimes in QuickBooks Online it's saved at the top near your favorite reports, and you're going to pull a profit and loss. If you scroll to the bottom of this report, the number at the bottom is called net income. If net income is a positive number, that's a good thing. It doesn't always mean that your cash is going to be positive, but it's the first step in having positive cash flow. If your net income number is a negative number, this is not good. It means that your expenses outweigh your income, and that is going to be detrimental to your cash. So if you are operating at a negative net income, you're going to keep driving your cash lower and lower because you're not bringing in enough revenue to cover those expenses. Now the scary thing is it takes about 2 to 3 times as long to dig out from that hole as it does to create the hole going into it. So be mindful of this. If you're running your business at a negative net income number, you need to look at your expenses and really hardly look at them and determine if there's any that you can cut, get rid of, you don't need. Same thing with your income. Review that. Are there ways that you can increase prices, get more customers, sell more products? How can you generate more revenue? Or look at both and figure out how to adjust both sides to get positive net income. Step number 2, you need to look at your debt. Now, debt is a 4-letter word. It is bad. Yes, there are times where debt is a good thing to buy equipment, machinery for your business. If you're going to get a rate of return on that investment and you don't have the cash up front to get that, I will go with that. However, debt is detrimental to your cash flow. Let me explain. A lot of business owners get in this trap because they are looking at their net income, and their net income on their profit and loss report is showing a positive report. So they're like, great, we're running in a positive, we must have positive cash flow. Here's the sneaky thing though. Your debt doesn't show up on that profit and loss report. Instead, it shows up over on your balance sheet and another report you probably don't see too often, which is your statement of cash flows. The debt is eating away at your cash and your profits every single month. You're making those payments, they're coming out of your bank account, but they're not showing up as an expense on your profit and loss. True story, I have a client who's running about $30,000 in net income every month. You'd think he was just swimming in cash. He's running a very profitable business. However, his payments going out in debt to cover his lines of credits, to cover his loans for all of his machinery and equipment, to cover credit card debt, is more than his net income number. So he's running a profitable business, yes. However, he's got lots of debt, and his debt is costing him about $40,000 to $45,000 every month. So he's having serious cash flow issues because his debt is in excess of his profits. Number 3, check and look hard and close at how much you pay yourself. Owner's draws are another quick and easy way to strip your business of cash without even realizing that you're doing it. If you're running an S Corp and you're on payroll, it's pretty easy to see what your salary is because it shows up on the profit and loss. However, if you're running an LLC, a single member, sole proprietor, a partnership, even an S Corp, if you're taking distributions in addition to your salary, those don't show up on your profit and loss. Every time you pay yourself, it's called a distribution or a draw, and those show up on your balance sheet. So take a look at your balance sheet. Same thing, go to QuickBooks, go to Xero, scroll to Reports, Financial Statements, scroll down to Balance Sheet. At the bottom of that report is a section called Equity, and you'll see your distributions or your draws down in the Equity section. This is a cumulative report, meaning the numbers grow over time. So you need to take the difference between last month and this month to see how much you took in distributions or draws for the last month. You can also do it for the last quarter or for year to date. If you are running a business, let's say that makes $20,000 in net income every month, you should not be paying yourself or taking draws in excess of $20,000. If you're taking draws of $30,000 every month, you are strapping your business for cash because you're taking more out. Another common trap with owner draws is using your business as a piggy bank. Your business is not your personal piggy bank. If your kids are going to college, you don't get to just draw that money out of the bank account. If you are doing a home remodel, you can't just draw that money out of your bank account. The business is not a piggy bank. You need to get in the habit of setting your salary, setting your draws to be in line and in relation to your net income, so you're not drawing more out of the business than what's coming in. If you need more money to live off of, there's things we can do. I recommend that you pay yourself first. This is a total mindset shift away from how most people think. But it's important. If you need more money to live off of than what your business is generating, you need to look at the expenses and figure out which expenses you can cut so you can pay yourself. But by taking more out of your business, by drawing $30,000 every month when your business is only making $20,000, you're killing your business and you're making it strapped for cash. I hope that helps. And all of these 3 steps are manageable, they're avoidable, and if you find yourself in them, we can help you get out of them, which is the good news. So if you have questions or you want help determining why your business is having cash flow issues, and B, help come up with a plan to get you out of those cash flow issues, reach out to us. Positive cash flow is the first step into building wealth and generating great wealth for you, your business, your family, and your employees. Give us a call. We'd love to help you. Thanks for watching. Have a great day. Bye-bye.